Usually when we talk about a massive construction project, there's this expectation of, well, visibility, right? You look at a city skyline, you see the cranes dotting the horizon, you hear the jackhammers.
Oh, yeah. You see the steel girders going up floor by floor.
Exactly. And as an observer, you can practically measure the progress with your own eyes.
Yeah.
It makes sense to us. It's a tangible reality.
It's incredibly linear, which is comforting. A foundation is poured, the framing goes up, the drywall goes in, and eventually, the lights turn on. We like that predictability in our physical world.
Right.
Especially when there are billions of dollars in the line. Wall Street in particular absolutely loves a linear timeline.
But then you step into the world of artificial intelligence and the physical infrastructure that actually powers it, and suddenly that visibility just vanishes.
Completely.
We are looking at a landscape today where the real construction, like the deployment of this unprecedented, mind-boggling computational power is happening completely out of sight.
Yeah, behind closed doors.
Right, it's occurring inside these massive, windowless, highly secured warehouses out in the suburbs or near hydroelectric dams.
Yeah.
And the financial blueprints for these invisible projects, honestly, to the average investor, they look like absolute mud.
They really do. I mean, it is the defining financial and operational puzzle of this decade. You have companies pouring billions of dollars into hardware.
Specifically GPUs.
Exactly. GPUs that historically become obsolete, or at least secondary, in a matter of just a few years. They are securing massive mountains of debt against future contracts that haven't even started generating a single cent of revenue yet.
It's wild.
It is. If you try to look at this through the traditional lens of, say, a standard tech company or even a traditional real estate investment trust, the numbers will just make your head spin.
Yeah.
It requires a completely different analytical framework to understand what is actually going on under the hood.
Which brings us to our mission for you today. Welcome to this Talk Tickers Deep Dive. Whether you're holding the stock, eyeing a potential entry point, or just trying to track the absolute explosion of the AI boon without losing your mind, we are here to translate Wall Street jargon into plain English.
And we've brought a pretty hefty stack of sources to the table for this one.
We really have.
Yep.
We are looking primarily at the CoreWeave, that's ticker symbol CRWV, their Q1 2026 earnings call transcript, their latest 10Q SEC filings, a rather, skeptical analyst note from Morgan Stanley's Keith Weiss.
Yeah, that was an interesting read.
Oh, fascinating. And also the credit rationale report from Moody's Investor Service. So today, we are pointing our microscope squarely at CoreWeave.
And just to set the baseline for you, in case you aren't, in the weeds on the day-to-day operations of this specific sector, CoreWeave is a cloud infrastructure company.
Right.
But unlike an Amazon Web Services or a Google Cloud that tries to be everything to everyone, CoreWeave is purpose-built entirely from the ground up for AI.
So they aren't building ChatGPT.
No. They manage GPU and CPU compute at a massive scale. They aren't out there building the AI models themselves. They are laying down the digital roads, the bridges, and the high voltage power grids that allow those AI models to exist, to train, and, to function in the real world.
They are basically the utility company for the AI gold rush. They're selling the pickaxes, the shovels, and the dynamites.
That's exactly it.
And our goal today is to keep this highly actionable for you as an investor. We're going to look at the headline numbers from Q1, explore the really complex operational story driving those numbers, and scrutinize management's guidance for the rest of 2026 and beyond.
And look at the bear case risks, too.
Absolutely. Finally, we'll give you our bottom line opinion on the stock. Okay, let's unpack this. We have to start straight with the data to see if CoreWeave actually met the sky-high expectations the market set for them. Because the sheer scale of their operation right now is, frankly, staggering.
It really is. The raw data from this Q1 call paints a picture of a company operating at a velocity that we rarely see, even in the hypergrowth tech sector. But the numbers also come with a lot of noise.
So much noise.
Which is why we need to dig into the filings.
Let's hit the top line Q1 revenue, $2.1 billion.
Massive.
That is up 32% sequentially from the previous quarter.
Right.
But the number that I found genuinely staggering is the year-over-year comparison. Revenue is up 112%.
Unbelievable.
They more than doubled their revenue in a 12-month window.
Yeah.
And, I want to pause here because we throw percentages around a lot.
Yeah, it's easy to become numb to them.
Very easy.
Yeah.
But doubling your revenue when you're a scrappy startup making like $10 million, that's one thing. You hire 5 more salespeople and land a few good accounts.
Right.
But doubling your revenue when your baseline is already over $1 billion, that requires a logistical, physical, and operational execution that is almost unfathomable.
It really does.
I mean, it means acquiring the land, securing the energy grid contracts, importing the chips, racking the servers, and getting them live for customers at a breakneck speed, all without breaking the existing systems.
Well, you're hitting on the physical constraint of this industry, right? Software companies can scale revenue infinitely just by duplicating code and opening AWS instances.
Yeah, zero marginal cost, basically.
Exactly. But CoreWeave is constrained by atoms, not just bits. They have to move literal tons of metal and secure massive amounts of electricity. So a 112% year-over-year growth at the multi-billion-dollar scale implies their supply chain operations are currently executing flawlessly.
But as massive as that $2.1 billion revenue number is, the metric from the call that had every institutional investor's terminal flashing like the absolute showstopper with the contracted revenue backlog.
Oh, yeah, the backlog.
According to the filings, it is sitting at $99.4 billion, basically a $100 billion backlog, and they signed $40 billion in new commitments in Q1 alone.
And what's fascinating here is the composition of that backlog and how it differs from what retail investors might be used to seeing.
How so?
Well, when a traditional SaaS company like a Salesforce or an Adobe talks about backlog or, remaining performance obligations, it often includes a lot of projected renewals or soft commitments that they hope will close.
Right. It's a pipeline.
Yeah, it's sticky, but it's not physical. For CoreWeave, this $100 billion represents ironclad, multi-year capacity contracts.
Wait, let me clarify that. Are you saying these companies are legally on the hook for this money, regardless of whether they end up using all the compute power?
In the vast majority of these contracts, yes. These are take-or-pay style agreements. The client is reserving physical space and physical power in a CoreWeave facility for the next 3 to 5 years. Yeah. And management noted on the call that 36% of this backlog is expected to be recognized as actual revenue in the next 24 months, and a full 75% will be recognized in the next 4 years.
That's incredibly fast.
It is. This isn't a speculative pipeline. This is a legally binding line of sight into their future cash flows.
Okay, so they have mountains of cash coming in today.
Yeah.
And an ever-sized mountain of cash legally promised to them in the backlog.
Yep.
But this is where I need you to translate the Wall Street jargon for us, because looking at the income statement, we run headfirst into what I'm calling the profitability paradox.
The muddy waters of infrastructure accounting.
Totally muddy. I'm reading the earnings sheet right now. Q1 revenue is $2.1 billion. Fantastic. But 2 lines down, I see a net loss of $740 million.
Right.
So on paper, they are bleeding cash. But then management spends 10 minutes touting an adjusted EBITDA of $1.2 billion, which translates to a highly positive 56% margin.
Yeah.
And then, just to throw a complete wrench into the gears, their adjusted operating income came in at $21 million. That is essentially a microscopic 1% margin.
It looks completely contradictory on the surface, I know. You have a massive loss, a massive profit, and a break-even number all describing the exact same 3-month period.
Completely contradictory. How can a company generate $2 billion, report a $740 million net loss to the SEC, but simultaneously claim to investors they have a 56% EBITDA margin? I mean, I hear the word adjusted, and I immediately think Wall Street accounting gymnastics.
Sure, that's a natural reaction.
Are they just hiding the fact that their business model is burning cash? Let me try to workshop an analogy here to see if I'm grasping this.
Okay, go for it.
Is this like buying an entire neighborhood of rental houses with cash? On day one, it looks like a massive financial loss because your bank account is totally empty, but you know the rent checks coming in over the next 10 years are going to be pure profit. Is that the dynamic we're seeing?
That is actually a highly effective analogy, but let's stretch it a bit further to fit the specifics of data center economics.
Yeah.
Because you didn't just buy those rental houses with cash.
Right.
You took out massive mortgages to buy them.
Right. Debt.
Heavy debt. So if we connect this to the bigger picture, you have to look at the physical structure of what CoreWeave does. They buy incredibly expensive hardware, thousands upon thousands of NVIDIA GPUs, specialized networking gear, advanced liquid cooling systems.
And that's not cheap.
No, it requires immense capital upfront.
Which explains the debt. But where does the $740 million net loss come from if they are pulling in $2.1 billion in revenue?
Well, it comes down to two massive expenses that hit the net income line: depreciation and interest.
Okay.
Let's tackle depreciation first. In accounting, when CoreWeave buys $1 billion worth of servers, they don't expense that entire $1 billion on day one. The IRS and standard accounting principles require them to spread that cost out over the useful life of the equipment.
Got it.
For AI servers, that's generally modeled at around 3 to 4 years. And because CoreWeave has been building at a frantic pace, adding unprecedented amounts of new hardware, their depreciation expense on the income statement is astronomical right now.
So it's a paper loss.
Exactly. It looks like a massive cost, but it's a non-cash expense. They already paid for the servers. They're just recognizing the aging of the equipment on paper.
Okay, I follow that. The rental houses are aging, and the accountant is docking the value of the houses every month, even though no new cash is leaving my pocket for that wear and tear.
Precisely. Now add the second major drag: interest. CoreWeave had an interest expense of $536 million in Q1 alone.
Wait, over $500 million just paying interest on their debt in a single quarter. That sounds terrifying.
It's a staggering number, but remember, they are financing the construction of global infrastructure. So your $740 million net loss includes that massive $500 million in interest payments and the massive paper loss of depreciation.
Okay, that makes sense.
Now, this is why Wall Street uses EBITDA earnings before interest, taxes, depreciation, and amortization. Analysts strip away the financing costs, like the interest, and the non-cash accounting rules, like depreciation, to ask one simple question: is the actual day-to-day business of renting out AI compute generating cash?
Okay, the light bulb just turned on. When management highlights an adjusted EBITDA of $1.2 billion, a 56% margin, they are saying, look, if you separate out the massive loans we took out to build this empire, and you ignore the accounting rules about our hardware aging, the core daily operation of flipping the switch and renting compute power to AI labs is a wildly profitable cash machine.
That is the exact takeaway. The underlying unit economics are highly cash generative.
Wow.
However, I do want to introduce a word of caution, which is something the Morgan Stanley analyst focused on. We cannot just ignore the debt and the depreciation forever.
Sure.
Eventually, debt must be repaid, and hardware actually does become obsolete and needs to be replaced with real cash, which is why that adjusted operating income number of $21 million, that tiny 1% margin, is arguably the most critical metric for us to dissect.
Because that operating income number includes the depreciation,
Yes,
right?
exactly.
It shows the profitability of the operations after accounting for the hardware costs, but before the massive interest payments.
Yes. And knowing that the operating margin is sitting at a microscopic 1%, we have to explore the why. I mean, a 1% margin leaves absolutely zero room for error. If power costs fluctuate or a client defaults, a 1% margin turns into a catastrophic loss.
And digging into the earnings transcript, the story behind those numbers reveals something counterintuitive. This 1% margin isn't a sign of a broken, structurally flawed business model. It's actually a temporary symptom of their hyperspeed growth.
Right. Management refers to this as the powered shell economics. And understanding this concept is the key to unlocking CoreWeave's entire margin trajectory for the next 3 years.
Okay, walk us through the timeline. Let's say it's day one and CoreWeave decides to open a brand new data center facility in, say, Texas. What actually happens to their financials?
Well, when they take over a new facility, they rarely build from the absolute dirt up. They usually receive what the commercial real estate industry calls a powered shell. It's a massive building. It has the high voltage power hookups to the local grid. It has the basic structural integrity, but the inside is essentially an empty cavern.
So it's a blank canvas.
A very expensive blank canvas. And it takes CoreWeave an average of about 2 months to completely fit out that shell.
Just 2 months.
Yeah, it's fast.
Yeah.
And the CEO outlined 5 distinct phases on the call. First, they distribute the internal power writing. Second, they install the massive, highly specialized liquid cooling systems required for these hot-running GPUs. Third, the complex networking cables. Fourth, they physically rack the incredibly heavy servers. And fifth, they deploy their proprietary software orchestration layer to make it all talk to each other.
I mean, 2 months sounds incredibly fast for that level of engineering. But from a financial perspective, Those 2 months are a total black hole, aren't they?
Oh, they are a severe financial drag. During those 60 days of fit-out, CoreWeave is paying the heavy lease costs on the building. They are drawing and paying for massive amounts of grid power just to test the equipment and the cooling systems. And crucially, the moment those servers arrive and get racked, they immediately start depreciating on the accounting books.
So all of these massive expenses, rent, power, depreciation, labor, are hitting the income statement at full force.
Yes, but they are generating absolutely zero revenue because the facility hasn't been handed over to the client yet. The client isn't paying for testing. They pay when the compute is live.
Of course.
This dynamic results in deeply negative contribution margins for that specific facility initially. And because CoreWeave is opening so many of these simultaneously, it drags the entire company's blended operating margin down to that 1% figure.
Let me see if I can put the scale of this drag into perspective, because their CFO, Nitin Agrawal, dropped a statistic that I had to read 3 times to believe.
The gigawatt number.
Yes. He noted that since the beginning of 2025, they have almost tripled their active power. They just surpassed 1 gigawatt of active power. And in Q1 alone, they added 400 megawatts of contracted power. I feel like we need to contextualize a gigawatt.
To put that in human terms, 1 gigawatt is roughly the amount of power needed to run a mid-sized American city.
That is insane.
Or, to put it in tech terms, it's about the total power capacity of several dozen traditional legacy data centers combined. And they tripled their footprint to reach that in just over a year.
So because they are adding hundreds of megawatts at a time, they have an enormous percentage of their total business sitting in that 2-month dead zone, where costs are firing but revenue is zero. They're eating massive front-loaded costs.
Imagine if you own a portfolio of 50 rental houses and they are all generating cash.
Okay.
But then you buy 300 more rental houses all at once. And for 2 months, you are paying the mortgages, fixing the roofs, and paying the property taxes, but you have no tenants yet.
Right, the cash flow would tank.
The profit from your first 50 houses is completely wiped out by the holding costs of the 300 empty ones. That pulls your total portfolio margin down to near zero.
But the crucial inflection point is month 3.
Month 3 changes everything. The testing finishes, the software is deployed, the servers go live, and they hand the digital keys over to the customer. Instantly, the revenue starts flowing against those fixed costs.
Nice.
Management stated that once a data center goes live, the contribution margins for that specific facility normalize rapidly into the mid-20s% range.
Which means, logically, as the sheer pace of their building eventually stabilizes relative to the total size of their empire, that 1% margin is naturally going to inflate.
It has to. If your installed revenue-generating base is 2,000 megawatts and you add 50 megawatts in a quarter, the negative drag of that small 2-month dead zone will be a tiny blip on your overall financials.
Makes sense.
The 1% margin we are seeing today is an optical illusion created by the sheer violence of the current growth curve.
Okay, that makes perfect sense of the financials. But I want to pivot here because the physical buildings and the accounting are only half the story.
Very true.
The real question is, what are these massive enterprise clients actually doing with all this compute power once the keys are handed over? And here's where it gets really interesting. On the call, management highlighted a shift in workload that I think is the most important takeaway of the entire deep dive.
Agreed.
They stated that inference workloads now represent over 50% of CoreWeave's total power draw. I want to spend some real time exploring this because it feels like a massive tipping point, not just for CoreWeave, but for the entire narrative surrounding the AI industry.
I would argue it is the single most significant validation signal we've received from the market this entire year. It answers the biggest critique the bears have had about the AI boom.
I'm going to bring back a variation of our medical school analogy to explain this, because the technical jargon around AI can get dense.
Go for it.
For the last 2 to 3 years, the entire tech industry has been obsessed with training AI models. Training is like sending a promising kid to medical school. You are pouring hundreds of millions of dollars into them, forcing them to read every medical textbook ever written, running them through endless simulations. It takes months or years.
Yeah.
And during that entire training period, they are generating absolutely zero revenue for you. They are just a massive cost center, learning how to be smart. That is the training phase of a large language model.
And it requires the absolute largest, fastest clusters of GPUs running at maximum capacity for months at a time. It's wildly expensive.
Right. Inference, on the other hand, is when that student finally graduates, puts on the white coat, goes into the hospital, diagnoses a patient, and you actually get to bill the insurance company for the service. Inference is the doctor practicing medicine.
That's a great way to visualize it. Inference is the actual tangible monetization of artificial intelligence. When you type a prompt into ChatGPT and it generates an essay, the compute power required to formulate that specific answer, that is an inference workload.
Yeah.
When a pharmaceutical giant uses an AI tool to map a new protein structure for a drug, the compute used to render that map is inference. It is the real-world application of the trained model.
And for a long time, really up until this quarter, the loudest bear case against the AI boom was that companies were spending tens of billions of dollars on the medical school phase.
Right.
They were buying up NVIDIA chips left and right to train these massive foundation models, but there was very little proof that they could ever make that money back on the back end through actual consumer or enterprise use.
Yeah, the fear echoing around Wall Street was that we were building a multi-hundred-billion-dollar highway to nowhere. The concern was that once the models were trained, nobody would actually pay to use them, the inference demand wouldn't materialize, and the whole GPU bubble would burst.
But the fact that CoreWeave's power draw has now officially tipped, that over half of their immense compute capacity is actively being used for inference, fundamentally disproves that bear thesis.
It does.
It proves that AI is delivering real-world return on investment for enterprises right now. People are actually paying to see the doc.
We are seeing that validation explicitly in their customer announcements. During the call, they highlighted adding Anthropic as a major customer to support the deployment of their Claude models. They also signed a staggering $21 billion multi-year agreement with Meta.
$21 billion. Wow.
Yes, and they explicitly noted that they are seeing expanding, not shrinking, commitments from their existing partners.
Now, I want to push back a little bit here, or at least explore a potential risk. We know NVIDIA releases new, faster chips every year or two. Went from the A100 to the H100. Now the Blackwell chips are rolling out. If inference doesn't require the absolute bleeding-edge compute that training does, doesn't CoreWeave risk sitting on billions of dollars of obsolete older GPUs that nobody wants? If a client can just use cheap, older chips for inference, why do they need CoreWeave's expensive new infrastructure?
It's a vital question, and it speaks to the complex hardware lifecycle in this space. The CEO, Mike Intrater, actually addressed this directly, and the dynamic he described is fascinating.
Okay.
He explained that the top-tier AI labs, the OpenAIs and the Metas of the world, will always buy the absolute newest, most bleeding-edge infrastructure. Let's say NVIDIA's newest Blackwell chips.
Right.
They use those exclusively for the incredibly intensive medical school training phase of their next-generation models, because time is money, and faster chips mean faster training.
Okay, so the newest stuff is always reserved for the heavy lifting of training.
Exactly. But here's the lifecycle cascade. Once that new model is fully trained, they don't keep it on the expensive Blackwell chips to run everyday inference.
Oh, interesting.
They move the trained model down to slightly older, less power-hungry infrastructure like the H100s or even the older Ampere architectures to run the day-to-day answering of queries. Meanwhile, they free up the Blackwell chips to start training the next version of the model.
Ah, I see. It creates a continuous cascading waterfall of demand. There is an insatiable high-margin market for the brand new chips for training and simultaneously a massive, exponentially growing market for the slightly older chips to run the inference loads.
Which is why the fear of sudden obsolescence is overstated. The hardware doesn't become useless the moment NVIDIA announces a new chip. It just shifts to a different, still highly profitable workload.
That's a huge relief for investors.
In fact, management noted on the call that they are entirely sold out of their older generation H100s and A100s. Even more surprising, they're actually seeing price appreciation, meaning they can charge more for them because the global demand for inference compute is outstripping the supply of these older chips.
That is an incredibly bullish signal for the entire data center space.
Right.
It secures CoreWeave's long-term business because it proves the utility and the shelf life of their entire fleet of servers, not just the ones they bought last month.
But to your earlier point about risks, building out infrastructure at this scale across multiple generations of hardware requires capital, deep, bottomless pockets. You cannot build a 1 gigawatt data center footprint with venture capital seed money.
Which brings us to what I think is the most underappreciated part of the CoreWeave story, their capital moat.
Oh, absolutely.
I was reading the Morgan Stanley note, And the analyst almost sounded in awe of the financial engineering happening behind the scenes. It's arguably just as innovative as the software orchestration layer they've built.
It absolutely is. You can have the best AI software in the world, but if your cost of capital is too high, you will get crushed by Amazon or Google.
The CFO, Nitin Agrawal, spent a significant portion of his prepared remarks discussing this. In Q1, they secured an $8.5 billion investment-grade delayed draw term loan. They refer to it internally as DDTL 4.0. Now, I consider myself fairly financially literate, but delayed draw term loan isn't exactly standard retail investor vocabulary. What exactly is this, and why was Wall Street so hyper-focused on it?
Let's break down the mechanics. A standard corporate loan usually works like a standard personal loan. A bank gives you a giant pile of cash, say $1 billion on day one.
Okay.
And the moment that cash hits your bank account, you start paying interest on the entire $1 billion, even if you are only going to spend it slowly over the next 2 years. It's inefficient.
Right. You are paying for money you aren't using yet.
A delayed draw term loan is different. It functions much more like a massive corporate home equity line of credit, or a HELOC. CoreWeave gets approved by a syndicate of banks for the full $8.5 billion, but they don't take the cash immediately.
Oh, I see.
They only physically draw down the cash, and crucially, only start paying interest on it, exactly when they need it to pay the contractors to fit out specific new data centers.
Oh, that is brilliant. It perfectly matches their powered shell deployment model we talked about earlier. They get the keys to an empty shell, they draw down exactly enough cash from the facility to buy the specific servers for that building, and then 3 months later, the revenue from that specific data center pays off the interest from that specific draw.
It is the ultimate form of capital efficiency. They are minimizing their interest drag during that dead zone, but the structure of the loan is only half the story.
What's the other half?
The real breakthrough, the thing that made analysts sit up in their chairs, is the phrase investment grade. This DDTL 4.0 achieved an A- equivalent rating from credit agencies like Moody's and Fitch.
No, wait a minute. I have to push back here. How on earth does a company whose entire business model relies on buying hardware that depreciates to near zero value in 4 years get an A- credit rating?
It's a fair question.
I mean, A- is what you give to established blue chip utility companies or massive conglomerates with decades of steady cash flow. Why do the rating agencies view CoreWeave's debt as safe?
It's a fantastic question, and it goes back to the $100 billion backlog. Moody's isn't rating the underlying value of the NVIDIA GPUs. They know the hardware depreciates.
Okay.
What Moody's is rating is the legal ironclad nature of those take-or-pay contracts. When CoreWeave secures a $6 billion contract with a financial giant, that contract essentially guarantees the cash flow required to pay back the bank. The debt is secured by the contractual cash flows of some of the most well-capitalized companies on Earth.
So they are essentially securitizing the AI boom. Unprecedented. And because the rating agencies view this debt as incredibly safe, the interest rate CoreWeave has to pay plummets. They price this $8.5 billion facility at an implied cost of debt of less than 6%.
And the CEO pointed out a staggering metric. They have reduced their weighted average cost of debt by about 600 basis points since 2023.
That is a 6% reduction in the interest rate they pay across their entire capital structure.
To equate it to a normal consumer, imagine refinancing a massive mortgage from 12% down to 6%. The monthly cash savings are monumental, and this dynamic creates a devastating competitive moat.
How so?
Think about the bear case. What if 10 new startups try to compete with CoreWeave? Well, if you are a new infrastructure startup and you have to borrow money at 12% or 15% because you don't have a track record or a $100 billion backlog of investment-grade contracts to show the banks, you simply cannot compete with CoreWeave on the final price you charge the customer.
Wow.
CoreWeave's cost of capital is now rapidly approaching the efficiency of the massive hyperscalers like Amazon AWS or Microsoft Azure.
And they didn't stop with the $8.5 billion. The CFO casually noted that they secured an additional $10 billion in debt and equity moving into Q2, bringing their total capital secured over the last short period to over $20 billion.
It's a massive war chest.
They even executed a syndicated public loan specifically to finance isolated contracts for OpenAI and Cohere. They have built an absolute fortress around their balance sheet, and they noted they have zero debt maturities coming due until 2029.
Which is the ultimate luxury in corporate finance. It means they have a clear, unencumbered runway for the next 3 or 4 years to just put their heads down and execute the build-out.
Right.
They don't have to waste executive bandwidth scrambling to refinance debt in a volatile macroeconomic environment. They have entirely de-risked their short to medium term execution plan.
All right, so with the current hypergrowth explained, the powered shell economics demystified, and the fortress capital structure laid out, we need to transition to what management is actually projecting for the future.
The guidance.
This is where we look at the guidance. And frankly, this is where the market usually finds reasons to panic if the numbers aren't utterly perfect.
Well, in a market pricing imperfection, the guidance was remarkably confident. They reaffirmed their full year 2026 revenue target of $12 billion to $13 billion.
Let's pause and do the math on that. Q1 revenue was $2.1 billion. If they simply flatlined at that rate, they'd hit about $8.4 billion for the year. To hit $13 billion, that implies a massive hockey stick ramp up in revenue generation in the third and fourth quarters.
It does. It implies that a massive wave of those powered shells are currently in the fit-out phase and are scheduled to come online and start billing clients in the back half of the year. Furthermore, they reaffirmed their adjusted operating income target of $900 million to $1.1 billion for the full year.
Okay, this is critical. Remember that tiny 1% operating margin we spent so much time on? If they were targeting around $1 billion in operating income on $13 billion in revenue, they're projecting an operating margin of roughly 7% to 8% for the full year.
Exactly.
Management specifically stated they expect operating margins to expand sequentially quarter over quarter and hit low double digits by Q4.
Because, as we discussed, the dead weight of the new data centers in the testing phase will be overwhelmed by the massive wave of revenue flowing from the facilities that finally go live. The ratio of building to operating starts to balance out favorably.
But the forward-looking number that really seemed to catch the analysts' attention and sparked a lot of questions in the Q&A was the annualized run rate, or ARR.
Yeah, that was a big one.
They raised the exit ARR for 2026 to between $18 billion and $19 billion. So they are expecting to ring in the new year of 2027, generating revenue at a staggering pace of nearly $20 billion a year. And by the end of 2027, they expect over $30 billion in ARR.
And here is the kicker that differentiates them from a software company projecting $30 billion in future sales. 75% of that projected 2027 number is already legally contracted.
Unbelievable.
It's already sitting in that $100 billion backlog. They do not have to hire an army of salespeople to go out and convince clients to buy it. They quite literally just have to finish building the physical infrastructure to plug it in and deliver it. The demand is secured.
Which naturally brings us to the elephant in the room regarding the guidance: CapEx. Capital expenditures. To build out the infrastructure for a $30 billion run rate, you have to spend an ungodly amount of money. They raised their full-year CapEx guidance to an eye-watering $31 billion to $35 billion.
And this raises an important question, right? Because historically, Wall Street has a physiological panic response when a tech company aggressively raises its CapEx guidance.
Right. If Amazon or Meta raises CapEx, the stock usually drops 5% the next day. Higher CapEx implies the company is spending way more cash than modeled, which compresses free cash flow, which makes dividend-seeking or value investors extremely nervous.
Exactly.
The analyst from Morgan Stanley, Keith Weiss, brought this up almost immediately in the Q&A. He asked if this CapEx hike was due to higher component pricing, like NVIDIA raising the cost of GPUs, or copper cables getting more expensive, and if that inflation was quietly eating into CoreWeave's core profitability.
It was a very pointed, very necessary question. And the CEO's response was incredibly illuminating regarding how CoreWeave actually structures its underlying business model to mitigate macroeconomic risk.
What did he say?
Well, he didn't deny inflation. He explicitly acknowledged that, yes, there is an acute shortage of certain critical components across the entire supply chain, and prices for specialized gear are absolutely inflating. But he explained that CoreWeave utilizes a contracting model called success-based pricing.
Explain that, because it sounds like corporate buzzword bingo. What does success-based pricing actually mean for the bottom line?
It means they don't guess what the hardware will cost 3 years from now and just cross their fingers hoping they guessed right. When CoreWeave sits down to sign a massive 5-year, multi-billion-dollar capacity contract with a client like Meta or Jane Street, they do not sign the final pricing sheet until they already have the hard purchase orders in hand from their own suppliers for the GPUs, the networking gear, and the power agreements.
They know the exact to-the-penny cost of goods sold before they commit to the final sale price.
Exactly. If the cost of NVIDIA chips jumps 15%, or if local utility rates for electricity spike, CoreWeave simply recalculates their model and passes those increased costs directly through to the customer in the final locked-in contract pricing.
So they are effectively entirely insulated from supply chain inflation.
They are acting almost like a toll road. They target a very specific internal margin profile, that mid-20s contribution margin per data center we discussed, and they reverse engineer the customer pricing to guarantee they hit that target, regardless of what the underlying components cost.
That's incredibly smart.
So when Wall Street sees the CapEx guidance get raised to $35 billion, they shouldn't view it as a runaway expense or a sign of an out-of-control budget. They should view it as a direct mirror reflecting an increase in locked-in future revenue. Higher CapEx simply means they are acquiring the hardware to fulfill more of that massive backlog.
The CFO literally said it on the call. CapEx shows up for us as more revenue and cash flow. It is not a sunk research and development cost. It is a physical investment with a guaranteed contractually obligated return.
However, while they are protected from price inflation, they still face the operational risk of availability. If NVIDIA simply cannot manufacture enough chips, or if cooling systems are backordered for 6 months, CoreWeave's deployment schedule gets delayed, which pushes back revenue recognition.
And management addressed that exact risk by highlighting their extreme focus on supply chain diversification. They are currently operating in close to 50 separate data centers globally. And they specifically noted that no single infrastructure provider or vendor accounts for more than 17% of their active footprint.
That level of operational discipline is crucial. If one specific facility in Virginia has a localized power grid failure, or if one specific vendor in Asia is delayed on delivering server racks, it does not cripple their global delivery schedule.
Right.
They have built a highly resilient, redundant physical supply chain that can reroute around bottlenecks.
And they are looking to expand that footprint even further. We mentioned they have roughly 1 gigawatt of active power now and 3.5 gigawatts of contracted power in the pipeline. But their long-term target is an incomprehensible 8 gigawatts by the year 2030.
It's massive.
And to reach that, they mentioned a significant shift in their real estate strategy. Historically, they have leased these powered shells from traditional commercial landlords. Moving forward, they are actively pursuing self-build sites.
Which is a massive evolution for the company. It provides them with much greater operational control and significantly higher long-term financial upside. When you lease a facility, you are ultimately subject to the landlord's rules, their timelines for structural upgrades, and their profit margins.
That makes sense.
When you execute a self-build, you control the destiny of the entire facility, from the literal dirt being moved to the pouring of the concrete, all the way up to the proprietary server rack design.
It requires more upfront capital, but as we established, they have a $20 billion war chest.
Exactly. It's the natural evolution of a company transitioning from a fast-growing tenant to a foundational pillar of global infrastructure.
Okay, so what does this all mean? We have walked through the staggering top-line revenue data. We've untangled the profitability paradox of the powered shells. We've explored the massive shift toward inference workloads, and we've analyzed their bulletproof, inflation-resistant guidance. Now, we need to synthesize all of this and deliver an actionable opinion for you, the investor listening right now.
Based purely on the source material we've dissected today, the earnings call, the credit reports, the filings, our verdict has to be highly bullish on CoreWeave's operational execution. They are operating at what the CEO very accurately described as escape velocity.
I completely agree. The numbers speak for themselves, but there was a very specific, almost offhand detail during the Q&A session that truly cemented the bull case for me. An analyst pointed out that with $100 billion in the backlog, CoreWeave essentially has vastly more market demand than they have physical power to supply. Yeah. And he asked the CEO if the word allocate was becoming a more accurate description of their sales process than the word sell.
And the CEO entirely agreed with that framing. He stated that it is an incredible privileged position to be in a business where the global demand for your product is so insatiable that you get to thoughtfully, strategically choose which clients you bring onto your infrastructure.
It's crazy.
CoreWeave is no longer a traditional sales organization desperately making cold calls trying to hit quarterly quotas. They are essentially an allocation board deciding who gets the lifeblood compute power they need to survive and compete in the AI era.
Now, I want to play devil's advocate for a second. Isn't there an inherent danger in that arrogance? If they are turning away smaller startups because they'd rather allocate power to massive corporations, aren't they potentially alienating the next generation of innovators who might build the next Google or the next Meta?
It's a valid concern, but from a purely financial risk management perspective, it is the absolute right move. Because they have the luxury of being picky, they are dramatically improving the credit quality and the safety of their customer base.
Okay, I see.
A few years ago, the bear case was that CoreWeave's revenue was reliant on risky, venture-backed AI startups buying GPU time with Series A funding that could evaporate overnight in a market downturn.
Right, the fear was that if the venture capital well dried up, CoreWeave's clients would all default simultaneously.
Exactly. But today, less than 30% of their backlog consists of non-investment grade AI native startups or foundation labs. The remaining 70%, the vast majority of their future revenue, is composed of solid enterprise-grade blue-chip commitments. They specifically highlighted on the call that traditional financial titans are now adopting their AI infrastructure at a massive scale.
That was a huge reveal. They mentioned Jane Street, which is one of the most secretive, massive quantitative trading firms in the world. Jane Street just signed a $6 billion capacity deal with CoreWeave and concurrently made a $1 billion strategic equity investment in the company.
Yeah, that's huge.
Why does a Wall Street trading firm need billions of dollars of AI compute?
Because the nature of algorithmic quantitative trading is evolving rapidly. Firms like Jane Street or Hudson River Trading, who they also mentioned, are constantly looking to shave microseconds off their trade executions and analyze unfathomably large data sets of global market movements in real time.
Oh, wow.
The parallel processing power of massive GPU clusters is perfectly suited for that task.
So it's not just tech companies building chatbots anymore.
Not at all. These aren't companies dabbling in AI so they can put out a flashy press release for their shareholders. These are cutthroat, quantitative giants whose entire multi-billion-dollar business model relies on maintaining a mathematical edge over the market.
Makes total sense.
If firms of that caliber are legally committing billions of dollars to CoreWeave for the next half-decade, it serves as the ultimate market validation. It proves that CoreWeave's specific infrastructure offers a tangible, quantifiable, high-speed competitive advantage over standard public clouds.
So, synthesizing everything we've covered, here is the actionable takeaway for you as an investor evaluating the AI infrastructure landscape. Do not let that 1% operating margin fool you. It is a temporary, easily explainable optical illusion that is currently masking what is, at its core, a cash-printing utility business.
Completely agree.
They have successfully secured the three hardest things to acquire in this specific industry: massive amounts of physical grid power, a bottomless well of cheap capital, and ironclad inflation-protected contracts.
They have a fortress balance sheet with no debt maturities until 2029. The runway is completely clear for them to just execute. They offer a unique investment profile. I mean, it is a heavy physical infrastructure play, but it features the revenue stickiness and predictability of an enterprise SaaS company.
However, we do have to acknowledge the long-term bear case, which is the looming shadow of the hyperscalers. Amazon AWS, Google Cloud, and Microsoft Azure are not sitting idle.
No, they're not.
They are aggressively building out their own AI infrastructure, and crucially, they are developing their own custom proprietary silicon chips to lessen their reliance on NVIDIA. If Google's custom TPUs eventually match NVIDIA's GPUs in performance and cost, CoreWeave, which is heavily leveraged to the NVIDIA ecosystem, could face severe margin pressure from hyperscalers undercutting them on price.
The hyperscaler threat is real, and it is the primary risk factor to monitor over the next 5 years. However, CoreWeave's argument, which the market is currently buying, is that their purpose-built architecture, their specialized liquid cooling designs, and their proprietary orchestration software will always extract more raw performance out of a GPU than a generalized cloud provider can.
Right.
For the highest-tier enterprise workloads, performance currently matters more than a slight discount on price.
So as we wrap up this extensive breakdown, I want to thank you for sticking with us through the mud of the financials on this Talk Tickers deep dive. But before we sign off, I want to leave you with a larger, perhaps slightly provocative thought to ponder. Circling back to that opening metaphor we used about building a city.
It's a perspective shift that I think is necessary to truly grasp what is happening in this sector.
If you look at the skyline, of any major, rapidly expanding city. The people who actually control the pace of that growth aren't always the visionary architects designing the flashy glass skyscrapers. Often, the true arbiters of growth are the unglamorous utility companies.
Yep.
A new skyscraper cannot open its doors, a new factory cannot start producing goods, and a city simply cannot expand any faster than the water mains, the sewer lines, and the high-voltage power grids can be laid down.
It's a bottleneck.
Exactly. So if CoreWeave now has the luxury, as the CEO admitted, of allocating computing power rather than having to sell it, are they really just a standard high-growth tech company anymore? Or are we watching them quietly transition into becoming the new sovereign infrastructure of the global digital economy? By holding the power to decide which massive enterprise gets the compute they need and which startup gets put on a 2-year waiting list, are they essentially acting as the ultimate utility that regulates the very speed of AI innovation itself? Think about the immense power of that position the next time you drive past a windowless data center. Until next time, keep digging into the numbers.